Welcome back, everyone. This is Mo Investing, and we keep things short and sweet, so let's jump straight in. Now, S&P Global is a stock that's down 23% in the last year, and that's largely down to them being included in the SaaS apocalypse or the fears of AI disruption on SaaS companies. Now, S&P Global does generate revenue a couple of different ways. They've got their credit rating business, in which they do operate in a duopoly with Moody's. They've got their market intelligence data platform. Commodity Insights is a segment in which they offer energy and commodities, price benchmarks, and analytics. They've also got their mobility segment in which they offer automotive data, and that's being spun off into its own company as well. And then famously, they have their indices like the S&P 500, where they charge licensing fees from ETFs, mutual funds, and the like. Now, if we look at some of the numbers for S&P Global, their market cap sits at 119 billion. Their PE ratios are on the lower end of the last couple of years, so their trailing 12-month PE is at 25, their next 12-month PE is at 19, and then their 2027 PE is at 18. They've got a decent operating margin of 43%. They do also offer a dividend yield of 0.95%, with them being a dividend king, as they've achieved 53 consecutive years of dividend increases, which is quite incredible to see. Their cash, they're sitting at 1.8 billion, and then their debt, they're sitting at 11 billion in debt, and that's largely due to a merger that they did in 2022 with a large information services company called IHS Markit. And then their stock price as of the 17th of May is at $403. And then if we do take a look at some of S&P Global's strengths, they do operate in a duopoly with Moody's in the credit rating space, so they are hard to displace in that market. They also, off the back of that point, they're deeply embedded in the credit rating space, and also their indices, so they're standardized across the financial markets in terms of their indices as well. And then finally, they're an asset light or capital light business, so even if we look at here in their outlook for 2026, they expect capex to be between 215 and 225 million, which compared to what the business brings in, which is around 15 billion it was for 2025, the amount of cash it takes to operate the business is very low compared to the amount of revenue the business really generates. So you can see that the business is very capital efficient or capital light to run. Now, if we take a look at some of the risks for S&P Global, and they do have some notable risks, their market intelligence data platform does face competition from the likes of Bloomberg, and then there's the AI risk of AI making access to information cheaper and easier, reducing the need for their platform, even though it does operate on proprietary data. There's also the execution risk with the separation of their mobility segment, so this could distract the business as well as not fully achieve the intended effect of re-rating the core business once the mobility segment is spun off. Then they also have some macro uncertainty risks, and they do note this in their Q1 2026 report. So they mention geopolitical shock like the Iran war, oil risk premium, macro uncertainty, as well as private credit stress, widening spreads, private credit repricing, and Mark's challenge. And then they also mention technology acceleration such as AI, and they also mention DeFi and quantum here. So there is a few things that the company is weathering that's causing uncertainty. If we move on to the Q1 2026 report, their revenue came in at 4.1 billion, increasing 10% year over year over the same quarter last year. Their operating margin increased from 50.8% to 51.8% in this quarter, and they repurchased 1 billion shares, and now they expect to return 100% or more of adjusted free cash flow through dividends and share repurchases back to the shareholder in 2026. If we go on to outlook, their guidance for revenue growth for 2026 is between 6.3% and 8.3%. They expect to spend between 215 million to 225 million in capex, and their diluted EPS, they expect it to be between $19.4 and $19.65. So essentially steady growth in 2026, nothing crazy. Going on to valuation, in my opinion, revenue growth for the next 5 years will be similar to the outlook for this year. So I'm expecting mid to high single digit growth year over year in terms of revenue. And then assuming operating margin increases, especially with the mobility business being spun off. So I'm going to go for an EPS growth rate here on our DCF calculator of 10% year on year for the next 5 years. And then I'll keep the multiple the same as the trailing trailing 12 months as it is now, so I'll keep it at 25. And you can see from our DCF calculator here that it would be a pretty reasonable return of 10% year-on-year growth, almost $650. Now this would be my base case for S&P Global. I do think there's more potential here if the business does re-rate once the mobility business is spun off, but for my base case I'm going to keep it at this. For rating, I'm going to give S&P Global a rating of 5 based on their strong moat with their credit rating business, as well as the network effects that are associated with their indices business. Now I do think their market intelligence data platform does carry more risk, but it does also have high switching costs as financial platforms usually do, so I think the rating of 5 is justified based on the entire business. Now for verdict, I'm going to give it a verdict of a buy, but it's more of a soft buy for me, not a strong one. I think it would become a strong buy at a cheaper price, or if you're sure that it is going to re-rate once the mobility business gets spun off, then I would consider it a strong buy here. But if not, I think it'll compound at a solid pace, not a very fast pace. So it's really up to your judgment if the price is really attractive. Now that's it for the video. As always, this is not financial advice. Please do your own research. But thanks for watching, and I'll see you in the next one.